future, we recognize that as a non-current liability in the statement of financial position. Deferred tax asset is a tax to be recovered by the company in the future. This one is recognized as a non-current asset. Now, on the other hand, we have said a deferred tax basically arises as a result of the difference between the accounting profit and the taxable profit. If these two profits are different, the accounting profit and taxable profit, that give rise to deferred tax. And basically, I've said the taxable profit is a profit which is computed by the company based on the existing tax laws. The accounting profit, this is a profit which is computed using the accounting standards and also the various accounting policies adopted by the company. Accounting policies include things like the methods of depreciation, how is the company depreciating its assets, and so on. So therefore, if these two profits are different, basically we are saying that will give rise to deferred tax. And basically what we were looking on this small illustration here, we have said that we assume the taxable profit of the company is 30 million. The accounting profit or the profit before tax is 40 million. The tax rate applicable to this company is 30%. And then what you're required to do is we compute the deferred tax. Now, we have said that for us to be able to compute the deferred tax, the first thing we need to do is to determine the tax which was supposed to be paid during the current year. The tax which was supposed to be paid by our company should be 30% of its profit. And basically, in this case, I've said, when talk about profit generally, we are referring to the accounting profit. The accounting profit in this case is how much? 40 million. So the profit, the tax which was supposed to be paid will be 30% of the profit, which is basically 40 million. That will give us 12 million. But now we then need to ask ourselves, is this the actual tax to be paid by our company? Is this the actual tax to be paid by our company? Automatically, no. Because you can see, there was this question, I think this was examined some time back. I can't be able to recall. And I think last sitting but one. In the sitting, I think is it April? Yes, April of 2025, there was still a question on this. So basically, I want us to do this question. Yes. So what are we told here? What are we told here? Yes. So we are told that 𝐅𝐍𝐋𝐈𝐍𝐄 Limited is considering a project with the following details. So we are given the initial capital cost is basically the initial investment, 40 million. And then we are given the residual or the terminal cash flow, 2.5 million. The selling price per unit, 1,100. The variable cost per unit is 500. And then we have the fixed cost per year, which is 5 million. Then we are given some additional information about the annual number of units sold are 30,000. These are the number of units which are expected to be sold each year, 30,000. And then you're given the project. We are told the project has arrived for 5 years. A project has arrived for 5 years. And then you're told the project uses a weighted average cost of capital of 12%. This is now the company's cost of capital, 12%. So what are we required to do here? We are required to compute part A, the base net present value. Part B, we are required to carry out sensitivity analysis of NPV, assuming adverse variance of 5% for all the inputs, except the project life and the weighted average cost of capital. So in this case, we are required to carry out sensitivity analysis by changing all the variables which are used in the computation of NPV with a 5% adverse variance. When talk about adverse variance, so when it comes to the cash inflows, adverse variance means that those cash flow inflows will reduce with 5%. Those cash inflows will reduce with what? 5%. When it comes to the cash outflows, like maybe the cost, like the initial investment, adverse variance means that those costs, those outflows will increase with 5%. Will increase with what? 5%. Will increase with 5%. That's basically what we mean by that. And then we are told to prepare an appropriate chart to indicate the difference NPV for each scenario in B above. And then you're told we are given an explanation here And note adverse variance in this case means decrease in cash inflows and increase in cash outflows. So we start with part A of this particular question. We start with part A. This now remember is our solution. We said always treat your Excel worksheet like that. You have your what? You have your solution on this side and the question here. So this therefore will be our solution. Our solution. Yes. So we start with the basically part A of the question, and part A. What are we required to do? We are required to compute the NPV. We just copy this one, we paste it here, Control C, Control V. Yes. How do we compute the project's NPV, net present value? We said the net present value, value. This one is equal to the present value of cash flows, present value of cash flows minus the initial investment or initial capital outlay, initial investment. Initial what? Investment. Now, if you check on this particular question, unlike the other question which we did, where we were given the annual cash flows and also the terminal cash flows, here we are not given those cash flows. But basically, if you check on this, in this question, we are told this company is intending to produce a certain product, and basically the company on annual basis is targeting to sell 30,000 units. So what we will do basically, we will compute We will compute the sales to be made by the company, and then we less the costs to be incurred. Like in this case, you can see we have the fixed cost and also we have the variable costs. So once we take the sales minus those two costs, we will be able to get what? The net amount of cash the company will be getting from these projects. So the first thing we need to start with here is basically the project life. We need to have the years here. And basically, we will have year one. Remember, you're told this project is for how many years? For 5 years. So we have year one all the way to year 5. Now, in this case, for us to be able to compute the sales, or actually for us to be able to compute these cash flows, there are a number of things we need to have here. For example, we need to have maybe the selling price. We need to have the unit to be sold. We need to have the variable cost and so on. So therefore, maybe we need to have a number of items here. So the first thing we will have here, we can have the selling price per unit, which basically will not change. Selling price, selling price per unit, So the selling price per unit, this one will be equal to what we have here. Although, for example, in an examination setup, you may just work with those figures the way they are here, but let's have it here. This will be 1100. And actually, is this changing? This one will not change, okay? So then from there, we can have the unit to be sold, the sales in units, the sales in units, sales in units. This one will be 30,000, this one, 30,000. And basically equally that one will not change. Okay, so you can see, for example, once I type that figure, we are told there is a typo, a typing error. What is the problem? You can tell us. The typing error here. Who can tell us? Why are we told there is a typing error? So whenever you're typing a figure within Excel, never use a comma. Never use a comma. Sasa? Yes. Never use that comma. Sasa? Yes. So basically we need to do away with this comma here. That's why we are told that there is a typo, there is a typing error. Yes, okay. So after that, we also need to have now these other costs. So we need to have the variable cost per unit. Variable cost per unit. Variable cost per unit. So the reason basically we're having all these data is because we're also going to use them in answering part B of the question. That's why we first of all we need to have all these data. This variable cost per unit is basically what we have here. Then from there, what else do we need to have? we also need to have the fixed cost per year. This one, I can just copy this. In fact, I could have copied all this instead of basically typing. So the fixed cost per year, this one is 5 million, like that. Yes. And basically these values will not change. So what I'll be able to do, I'll basically apply this for the next 5 years. Okay, so let's have this one here. Okay, so the same case here. This one will be equal to this. Yes, like that. Yes, so basically those are the values we need to have for us to be able to compute our cash flows. So having this now, we need to move and compute what? We need to compute the annual cash flows. How do we compute the annual cash flows in this case? To compute the annual cash flows, we will take our sales minus the costs, minus what? The cost, of which in this case we have two costs. We have the variable cost, and then we have what? We have the fixed cost. So basically this is how we compute what? The annual cash flow. So basically what we need to do here is first of all, we start by computing the sales. How do we compute the sales? Sales is computed by taking, we can just refer to that as Q, the quantity to be produced and sold. We multiply that with the selling price per unit. The selling price per unit, maybe you can just represent that using what? Using P. So we will take this one, selling price per unit, times the number of units which are expected to be produced and sold. So this one will be equal to this one, selling price per unit, times this one here. Yes, and basically that will give us 33 million, which will not change basically. It remains the same. It remains the same up to year 5. That one will not change. It remains the same. It remains the same. Yes. So then to this, we need to less now the costs. So to this, we need to say less cost. So which cost do we less here? In our case, we only have two costs. We only have two costs. That is basically the variable cost, this one, and the fixed cost. Those are basically the two costs we only have in our case here. You can start with this one. Okay. And then this one here. And this one will not be per unit. This one will not be per word, per unit. So the variable cost, how do we compute the variable cost? This one will be equal to the variable cost per unit, this one, times the number of units to be produced and sold, these ones. What about the fixed cost? The fixed cost will be equal to this one. Basically, those costs will not change in the next 5 years. They will remain the same. I just need to apply that for the next 5 years. Now, having that, then I need to move, and I do what? I compute the annual cash flows. The annual what? The annual cash flows. The annual cash flows. And basically, the annual cash flows here, this one will be equal to the sales minus the two costs. So I will take this one minus this one, and basically get what? The annual cash flows. So I apply that formula up to year 5 like that. I can also, in this case, bold this one. Control B. Yes, I think I can just bold that one. Yes. So we have the annual cash flows, But remember also in our case here, we also have the terminal cash flows. We have this, the residual or the terminal cash flows. So remember, you see that this is the cash flows, which is expected to be generated at the end of the project life. This one is a cash flow to be generated in year 5 at the end of the project life. So basically, which is 2.5 there. 2.5, yes. 2.5, yes. I think we are okay. That is okay. Yes, alternatively, we may decide to add it here to the last figure. We may decide to add it to the last figure here. Yes, so let's just add it here because we need to get other totals here. No need of doing that. Let's just include it here. Let's just add that here. Let me first of all close this bracket. Close this bracket, and then to this I will add this one like that. Yes, let me do away with this. Let me do away with that there. Yes, now having cash flows, these annual cash flows, the next thing we need to do is to discount them. So to discount these cash flows, I'll multiply this with the present value interest factor at the rate of 12%. This now what you're required to use the rate of 12% at the rate of what? 12% like that. Sasa, yes, you also have to recall the formula which we use here. It will be the formula which we use here should be 1 plus what? Plus small r, and basically we raise that to power negative n. So remember, you say today's power, we shift number 6. Shift number 6 raised to power negative n, small n like that. Yes. So that is basically the formula you need to recall. So to compute this, we will take 1 plus r, which is basically 1.12, because our r is 12%. Our r is 12%. We shift number 6, and then we raise that to power negative 1. Don't type, pick whatever you have up here. That one. Sasa, yes, because basically you're going to apply that formula. We do what? We enter. And I hope that is correct. 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 Is that correct? Is that correct? Is that correct, Ruth? Is that correct? Yes. So that one is correct. That one is correct. That one is correct. So what we just need to do is to enter. Okay. We need to enter. To enter. Yes. And basically what we can do in this case, let's work with this figure to the nearest to 4 decimal places. We just need to come up there and reduce the decimals to 4 decimal places like that. Then we need basically to apply this up to year 5 because we already have a formula there. What will only change here is the power. That's why I've said when computing this, don't type this -1, because if you apply that, like maybe we can see what will happen here. Let's see what will happen here. If, for example, here instead of picking this one, we typed -1. Let's see what will happen if, for example, we type, instead of picking this value 1, we just typed -1 and we enter. We are going to get the correct value, but when it comes to applying our formula here, you remember by default, Excel should be able to use these values which we have here. But now once we have typed 1, let's see what will happen. You can see what is happening. Excel is basically working with this formula which we have here. Sasa, yes, the power is not changing. That's why I say when having the formula for this, don't type -1. Instead, pick what we have up here. Pick what we have up here, this one. Yes, and then you apply that formula across like that. Yes, that is basically very much correct. So then from there, we need to proceed and basically we get the present value of cash flows. The present value of what? Of cash flows. The present value of cash flows. So how do we get this? We basically need to multiply this annual cash flows with the present value interest factor, this one, and then we enter. Equally, I think we can work with this to the nearest whole number. We just need to come up here. We reduce our decimals to the nearest whole number. And then basically we apply that formula up to year 5 like that. Yes. So in our case now we have the present value of cash flows. So basically what we just need to do is to get the total. We just need to get the total. We just need to get the total. We just need